Welcome to the WA Property Q&A, the podcast where I explore the ins and outs of buying property in Western Australia. I'm your host, Peter Fletcher, and each week I interview local property experts to help you to develop a deep understanding of the nuances of buying property in WA. From market trends to legal considerations, no topic is off limits. But before we dive in, a friendly reminder. While we provide valuable information, it's important to note that nothing discussed in this podcast should be construed as personal investment advice. Always remember to seek the appropriate professional advice for your specific circumstances. Now, let's get started and unlock the secrets to successful property buying in WA. Welcome to another episode of the WA Property Q&A podcast. And with me today is my good mate and mortgage broker, Ryan Tripi from Westminster National Finance Brokers. Ryan has been a mortgage broker for how many years now, Ryan?
7 years, over 7 years. A decade in finance with Westminster, a couple of years at the bank. So, yeah, been in the industry a long time.
With Bank West.
Commonwealth Bank.
Oh, the Commonwealth.
Yeah, big brother.
Same.
Same.
Yeah, yes. Welcome, Ryan. So today we want to talk about all things finance, and of course what's on everyone's lips is what's happening with interest rates. And so keen to get your thoughts. And look, we understand right up front that these just are your thoughts. They don't represent any sort of thoughts from Westminster or from any of the banks that you lend to. But you know, what's your feel on where interest rates are going?
Yeah, I mean, the general consensus in the market and what we're hearing in the industry is, rates are peaking or maybe at their peak. Mm-hmm. So can't see there being too many more rate rises, if not at all. And with the fixed rates coming off and continuing to come off, I think we may see potentially some rate cuts next year.
So a fixed rate, you're saying fixed rates are coming off, are they?
They are.
Are they? So that's the market saying that rates are on a downward trajectory.
It's not so much that, it's more probably the inflationary data, which is being closely monitored. So I know the Reserve Bank is looking at that very closely. So if that continues to trend downward, then we'll see rates continue to remain on hold. Probably going to be some time before we do see a rate cut, but I think we will be holding on to where we currently sitting at the moment for a period of time, unless that figure starts drifting upwards.
Ryan, I know that we didn't talk about this pre the show, but I'm keen to, if people come to you and say, well, do I go a fixed rate or variable rate? What's your thinking there? If I come to you and said, well, should I go fixed or variable?
Yeah, I'm looking closely at your circumstances. If you're really needing to stick to a tight budget, probably going to lean towards having some fixed rates in there, or an element of it, just for that rate certainty, especially in a market where we've seen so many rate rises. It's still still front of mind for a lot of borrowers out there. So circumstances would be driving my response to that. But yeah, I guess as I was saying, with my sort of personal opinion, I think rates are somewhat at their peak. So a lot of borrowers at the moment are taking the variable as opposed to fixed. There's not a whole lot of people going fixed at the moment because the incentive's not there. Variable rates are cheaper than fixed rates. Simple as that.
Mm-hmm. And what's your what's the average size of the mortgage that you're setting at the moment? What's the number?
It will depend on the finance broker, I guess. But, generally speaking, our market's moved a fair bit. So you're not going to get too much. It's hard to find properties in that sort of lower end of the market, I guess. You're probably seeing an average mortgage around sort of 700 plus.
Yeah, right.
Yeah, at the moment.
That's no small mortgage compared to what it used to be.
Yeah.
Yeah, back in the old days.
People have adjusted their reality as well. It took a bit of time, but people are realising that I guess our market hasn't really seen so much growth in the property space. So, it's been welcomed for landlords or property owners. But yeah, people wanting to upgrade or get into the market, first home buyers, it's a real struggle. I've seen a lot of first home buyers and not a lot being eligible for any of the incentives. Quite simply, they're just not adequate for the current market. I don't know why it's not adjusted. Heard a conversation the other day from one of the property experts suggesting a good idea, maybe indexing the first home buyers' incentives to the median house price. I think that's pretty sensible.
Yeah, well, they haven't adjusted that for I don't know how long. I can't remember when it changed last.
Remember.
It started. It's been at 4.30.
Yes.
Starting point for. I can't remember when it.
Well, the only ones I'm seeing that may fit into that category is really just a single applicant. Any time there's joint applicants, generally they're having to, sort of push it beyond the first home buyer incentives. So very difficult for a first home buyer. You have to buy an apartment. Really, it's the only option.
Yeah, if they want to use those stamp duty concessions, those sorts of things.
I guess to that point, it's not the be all and end all. You shouldn't be buying a property just to save a bit on stamp duty or trying to get a grant from the government. It should really suit your circumstance.
Yes, that's good advice. Yeah. So you're talking to a fair few first home buyers. Sounds like it's struggle town for them.
Yeah. See a steady few. Seeing a lot of mature borrowers as well. So coming back, started off being their first home, but now coming back to upgrade, having kids, needing more room. Looking at other ways to had some cash reserves and wanting to, seeing how strong the rental space is. So trying to, get an investment property and have a residual income stream. So seeing a good mix.
Okay, so it's across the board.
It's across the board.
You're always in front of us. You're always in front of the real estate agents. What's your take on what's going to happen in the market for the next few months? Where's it going?
The list.
And I know I'm asking you to look into a murky crystal ball, but what's your sort of
to
vent
the frustrations of the borrowers I'm seeing? It's the lack of supply of property, which is I'm doing a significant amount of pre-approvals because it's such a heated market. Trying to get the buyers best positioned to be able to put an offer in in a highly competitive environment. So the frustration is just not enough supply of properties. It's probably the general theme, and that will continue. That's not going to get solved overnight, and that'll be here for another year, two years. Can't see it changing anytime soon.
It is hard to see what is going to change there in terms of where the market's going. It's really hard to see.
Construction sector's still under a lot of pressure. Heard another property specialist make another good point the other day, saying that we maybe need to look at bringing in more migrants to be able to service the construction sector, skilled workers,
which in itself creates its own problem. You bring the migrants in, where do they live? And now you're putting pressure on the rental market.
Yeah, you could probably so the caveat he had to that was putting a caveat on the visa, so they could only work in the required fields, one being construction, and not just come in and then just go work up at the mines and earn a bucket load of money. But you're right, they would need somewhere to live, but if you bring in skilled workers that can build properties and should outweigh living requirements.
It's that solution is going to take. It's going to take 2 to 3 years before it starts seeing any sort of benefits. Before the supply starts flowing into the system.
Yes.
And from what I'm seeing, that there's almost no appetite to build multi-story. It's just no appetite for it.
Yeah. I think you're right.
Tricky stuff. Fixed rate cliff. A lot of people talking about the fixed rate cliff going back. When did it start becoming a topic of conversation? 12, 18 months ago?
When rates started going up.
Yeah, so
Probably the
12
third or
months
fourth,
ago.
consecutive rate rise. Yeah, it would have been 12 months ago. The mortgage cliff is a reality. A lot of people still on their fixed rates, so not everyone has come off yet. So sort of economists, bank economists, this is sort of suggesting that I think it was 70 or 65% of mortgage holders will be sort of coming off end of this year, and then sort of up to sort of 95% sort of by June 2024. So you're going to see most people off their fixed rates and actually facing reality on some pretty high variables, meaning doubling, tripling, quadrupling of repayments on some occasions.
Some of the predictions going back, 9 to 12 months ago were pretty dire. There were people saying that, this mortgage cliff would just tank the economy, it would tank the property market, that prices would go down. Are you seeing that?
Because of the supply issue, I can't see how prices will come down. I can see there being a world where we still face a lot of pain economically with property prices remaining stable. Mm-hmm. So that world is still a reality. But fact of the matter is our state, WA, our market's still very affordable compared to the others. So seeing a lot of interstate investment at the moment.
Are you dealing with many people that are on fixed rates coming back to you saying, Ryan, we need to do something here?
Definitely.
Is that a fact?
Sometimes 6 months before it expires. Without being comical, 6 months is still a fair amount of time before it expires. But I guess they're just thinking about what's coming up, which is great. So you just got to be the best way to prepare is set your expectations for and adjust your lifestyle ahead of time, not when it comes off. So realign your budgets, revisit your budgets, and yeah.
What's the mitigating things people can do to stop the pain? What are people doing?
The positive lens is most people have seen some growth in their property. So despite rates going up, there's still been some equity potentially realised in the property. Mm-hmm. So it's not all been bad. Mm-hmm. But all you can do is try to control what you can control, and discretionary expenditure. Monitor that closely. Anywhere you can pull back, suggest to do so before it's too late, I guess, because the downsizing is also potentially a reality as well. So people buying emotionally at very low rates and sort of overextending themselves and then having to readjust.
That's a fairly negative thing to do, isn't it?
It is. It's hard reality to face, to be able to.
And it's almost not worthwhile, because in the process of downsizing to reduce your mortgage, you've just picked up another 30 grand in stamp duty, another 25,000 in agents fees, and the list goes on. You almost think, well, could I have just restructured things to
it's a very good point.
Ride it out?
You want to be making sure it's a last resort. So you've pulled all your levers before pulling that lever, so to speak. So it may be downgrading the car, getting rid of the boat if you have one. Lifestyle, discretionary expenditure, pulling all that back first before having to pull the property lever, I would have thought.
What would be your advice to somebody who came to you and said, "Oh, look, Ryan, we're worried about it. We don't think that we've got the resources to to ride this out," and they did have a flash car. Would you say rip the Band-Aid off earlier, or just say, well, just see whether you can ride it out?
No, the worst thing you do is put your head in the sand. You want to be getting ahead of the curve. I'd be looking at the reality now. Let's have a good look at where your income sits. Let's have a good look at where your expenditure sits, and and see what sort of surplus we're left with. If there's no surplus as a deficit, then we've got to see how we can try and pull that back so there is a surplus.
Yeah.
You don't want to be just meeting your commitment. Well, you want to be meeting your lifestyle and also meeting your commitments as well. So, there's no point, suggesting that you can live off 2-minute noodles because that's probably not a reality. You still need to maintain somewhat of a standard from a living perspective.
Nothing wrong with 2-minute noodles.
No, there isn't,
Ryan.
No.
They're quite tasty.
Not every day, Pete.
But you're right about the don't put your head in the sand. It's like address what the problem early. Yeah.
Yeah, definitely. Yeah. So looking at things 6 to 12 months out is very reasonable. Earlier the better.
And to the people that are still thinking that the property market is going to tank as a result of the fixed mortgage cliff, my take on it is it's not going to happen. Yeah. There's too many other factors at play that's going to keep prices either at the level they're at. Actually, I believe they're going to continue to rise. There's so much positivity in the market at the moment.
I agree.
What's your thoughts?
I agree 100% with you. Yep. I can't see prices coming off. I can see people having to potentially adjust what property they're in, which doesn't necessarily mean that property prices are going to come down because you're going to have other buyers that are capable of buying that property. It's not going to be a downturn in the market because there's a whole lot of distressed borrowers out there. There's going to be a pool of distressed borrowers, but there's also going to be some that are willing to snap up those properties because they didn't have access to them previously, or it's a good opportunity to buy now.
And are banks giving a bit of latitude to people that are, sort of tapping on the rev limiter? Are they saying, look, let's talk about, repayment holidays or, extending? Yeah, is that something that people can do?
Yeah, definitely. Proactively reaching out for help. Generally speaking, shouldn't deteriorate your creditworthiness either. What will deteriorate it is putting your head in the stand, going into arrears with your bank. So talking about your circumstances, especially if there's an event or circumstance that's changed, that you'd have a chat to your bank and seek some help or speak to your broker.
Okay. I got another question, and it's a bit of one that sort of came to mind as you were talking there about rising prices. So let's say you've got a first home owner that has just under 10%. Like they might have 45 grand in the bank, and they need just a little bit more. What's your advice to somebody like that? In terms of, should they wait until they get the right amount of money in the bank, or just bite the bullet and buy something and, get their name on a title and let the property growth take care of the equity side of things?
Very good question, Peter. Depends on that person's circumstances, but potentially both sides of that. Your answer there could be right. So it could be best to buy now, or it could be best to hold off. From a finance perspective, if you were to hold off, save up a bit more, structure the loan a bit better, you could save a bit on the finance front. But by waiting that time to save up to that level, you may have missed out on
How much would they save by putting the mortgage, getting their deposit right and getting the mortgage structured properly?
Yeah, if you're in lender's mortgage insurance, it's percentage based, so depending on how much deposit you're throwing into it, borrowing 90% of the property value and beyond that becomes ultra expensive. If you can try and keep it under 90, so 89, 88 sort of percent of the property value, you're going to save a fair bit on lender's mortgage insurance.
Because my thinking is, let's say, and I don't know how much mortgage insurance is, but let's say it costs 10 grand in mortgage insurance and, other. They'd be better off getting into the market and paying the 10 grand and picking up 40 grand in capital growth on a $400,000 property, which is probably
Yeah, that's right. If that's the reality, if there's going to be that sort of growth, then it's just a cost to the property really at the end of the day. It's a risk fee the bank passes on to the borrower. You pay for it, it gets capitalised, you pay it over a potentially up to the 30-year term. So yeah, it's just a cost to get into the property. So if it's going to cost you 10 to get in now, but you're going to see 40 grand worth of growth, then yeah, get in now.
People can't get that mortgage insurance premium back, can they?
You can. There is some circumstances that will allow a transfer or a discount to premium depending on what you're doing. So if you're swapping a property out, you've already paid it, potentially there could be a waiver or discount. So there is some circumstances.
Okay. Home loan structures. Let's have a chat about that. What are most people doing in terms of home loan structures? Offsets, redraws, and I know you're going to say individual circumstances.
You betcha, Pete. You betcha. There's no generic answers here.
But we're just talking amongst friends here.
Yeah. Right? No, from a personal opinion perspective,
yes.
I like offset accounts. I think they work really well. I also love credit cards as well, but that doesn't work for everyone.
Yes.
So
what I like about offset accounts, and I've actually never had one, but yeah, no, honestly, I've never had one.
They never used to be around, in fairness.
Yeah,
I remember.
back in the 20s.
Yes.
So what I like about them is you've got a bunch of your cash in the bank.
Yeah.
And there's a certain level of comfort in that.
Yeah. No, I'm a big fan. There is some differences in lenders. Some will only allow one offset account against the loan. Some will allow multiple. I love the lenders that allow multiple. I think it's really great from a budgeting perspective. The more money you've got sitting in those offset accounts, the quicker you're going to pay back your mortgage. The flip side to the offset accounts is obviously that redraw function. Most of the lenders' products have redraw as a default option. So even with an offset account, you're still going to have redraw, so you can do both. Some people like that mental thing of actually putting money onto the mortgage. So circumstantially, doesn't work for everyone.
Having
but I personally,
having a redraw facility is like having this giant credit card.
That's true.
You pay it on your credit card, and then you pay the credit card out of the redraw facility, and it's just like you never actually see the cash disappear.
The only way you do that is permanently reduce your redraw. So the effect of that is you can actually lower the minimum monthly commitment on the loan. So some people might want to initially borrow a substantial amount for investments or what have you, and then they no longer need that or want to reduce the redraw availability. So you can go to your bank and actually reduce that down, and that will reduce your minimum monthly commitments. That will permanently reduce your mortgage as well. So
Yeah. So if you'd paid off, let's say $200,000, and you didn't need a redraw facility of that, you might say, well, give me a redraw facility of 50.
Yeah, spot on.
Okay, that makes sense. And of course, what's the difference between an offset and a redraw? Is there?
Good question. There can be a big difference, but they will have the same effect. So if you put money into the home loan itself, you're reducing your outstanding balance, so you're going to reduce your interest charges on the mortgage. If you house the money in the offset account, it'll offset the mortgage, so reduce your mortgage interest charge. So if you had $100,000 put into the home loan, or you had $100,000 offset, it'll have the same effect in terms of saving you on mortgage interest. The difference being with an offset, I guess, to a redraw, is to be able to continually save money with that redraw set up in isolation. You need to be continually putting money into the mortgage, making extra repayments to save you that interest. Whereas an offset account, you can just have your money collectively pulled in there, or have your salary credited into that account. So every day that's sitting in there, it's going to save you on interest.
Okay. All right. Now, I want to talk about the best entities for people to buy properties in. And I can see you.
Dangerous waters, Pete.
So at the start of this podcast and at the end of it, there is a massive big
Disclaimer.
This is education.
Yeah.
It's not personal advice, and we don't want people to act on whatever we say here.
Yeah.
So if someone comes to you and says, what entity should we buy this property in?
Yes.
Your standard answer is?
Personal circumstances, Pete. But if you're a business owner, I'll give you some scenarios. Business owners will generally put properties in their wife's name. That's an asset protection measure.
Or their partner's name?
Yeah, partner's name.
Mm-hmm.
Yes, partner's name. Yes.
Yeah.
It's usually taxation or it's a risk mitigation methodology behind the borrowing structure.
Yep. But that's something that they should be talking to their accountant or their
because
financial
circumstances will drive how you should buy a property.
Yes.
So your owner occupier should always be purchased in individual names, is my understanding.
Yep.
Some people have it in trusts and companies and have a creative accountant, but generally speaking, it's in personal names. Investment properties, that's when it goes into that. You really need to get some good tax advice or financial planning advice as to what's going to work well.
Yeah. All of this comes into what's your long-term strategy too.
Yeah, 100%.
So, what's where are you going from here?
Spot on.
Okay. So I want to round it out with trends in finance, Ryan. What innovative finance products are out there? Is there any? Or is finance this sort of innovation-free zone?
The world's becoming more efficient. It's more so not so much the products themselves. It's more lenders trying to make it quicker and trying to take more market share. It's a highly competitive environment. So the quicker they can get an approval, the quicker they can confirm to an applicant that they're good for the money, the better for us as brokers and the better for the borrower. So the digital world's here and it's continually being revolutionised. From identification to application signing to formal loan document signing to Landgate potentially coming on board. I think we're the last state to become digital, that's my understanding. But
we're not called wait a while for nothing. Yes.
So they're the trends we're seeing, and policy changes. Lenders are getting creative around trying to find ways to make things easier, especially in that business space. It's great to be able to have a pool of lenders to be able to have access to, and because every business and personal circumstance is different. So it's not one lender that suits everyone. So the more products and solutions we've got, the better.
Rhino, before we came on air, we talked about portable home loans, portable mortgages. And my question to you was, I'd heard that portable mortgages were a thing in the same kind of way that you could change from Telstra to Optus to Vodafone on your mobile device, and it was like could be done in minutes. And I'd heard that mortgages were going to go down the same path. Is that not the case?
Not the case. There's still a credit assessment component to it. There is a simplified version of that credit assessment, but it's not as simple as just swapping out. There's still responsible lending obligations from the lender, and us as a broker, we've still got compliance, data and information we need to hold to ensure we're putting the client in the right structure. So not as simple as swapping out, but simplified, Peter.
Yeah,
that makes sense to you.
Simplified, yeah. So you use the term mortgage prison?
Yes.
Yeah. What is that?
Yeah, so there is some policies that's come out somewhat recently to alleviate a little bit of that problem, not completely eliminate, but a few measures like reducing the serviceability buffer in terms of refinancing say an ANZ to a CBA sort of product, like for like, not borrowing any more money, but just trying to switch to obtain a better deal. The lender will just basically assess your capability on the rate that you're paying, and then just add a 1% on top just to stress test to see how your affordability stacks up. And generally the market sits at a 3% buffer. So there's a more simplified, an easier way to sort of refinance now as it was. Historically, it was it's just standard assessment. So it's helped that problem.
And you're probably not in a position to name names as in bank names, but any of the banks better to deal with, easier to deal with, easier to get finance through than others? Is there a difference?
Very good question, Peter. A very good question. I hate to use this again, but it's circumstantial.
God, you and your circumstantial. I'm going to kill you.
If I do a lot of business, I deal with a lot of business customers. So if I put that hat on, there's a pool of lenders that look at business customers very well, in terms of their interpretation of the data. Simplification is probably the best way to put it, especially in that business world. Applying with lender A might be extremely complex, but if you go to lender B, they can look at the same data, but effectively interpret it a lot more simplistically and with common sense. Back
when I owned a rent roll, it was common to use the rent roll as security for loans, and Macquarie Bank were the go-to bank for rent roll lending.
Yep.
They were also the go-to bank for buying house franchises. They knew the ins and outs of house franchises, and that's who you went to fund the loan. Are you still seeing that with some lenders where they specialise in certain
definitely.
niches?
They float in, they float out too.
Yeah, right.
Especially in that business world. In home lending, a bit different. It's very much a cookie cutter, I guess. With home lending, it's not as complex. So all the lenders will play in the space, but some will have their niches, I guess. In the business lending world, some lenders have appetite for real estate agents, some don't. Depending on what sort of business you're running.
Ryan, this has been fantastic. Thank you for your time. It's always a pleasure to have you on board.
Thanks for having me.
Now, for people that want to speak to you and ask you more and get your advice on their particular circumstances.
Yes.
See, I got one in there, mate.
Yes.
How would they get hold of you?
Easiest way is you can visit the website and look me up if you want to do your own research. But best is on mobile, so 0407 007 386, or on email, or visit the website.
There you go. You can send Ryan your pics over the weekend.
There you go.
Ryan, this has been fantastic. Thank you. And until next week, this has been the WA Property Q&A podcast.
Thanks, Sam.
And that wraps up another episode of the WA Property Q&A. We hope you found our discussion valuable and gained some valuable insights into the world of property buying in Western Australia. Remember, while we strive to provide useful information, it's crucial to consult with the appropriate professionals before making any investment decisions. Don't forget to tune in next week for another exciting episode where we continue to unravel the mysteries of the WA property market. If you have any questions or topic suggestions, feel free to reach out to us. Until then, happy property hunting, and remember to seek the right advice for your personal circumstances. Thank you for listening.